Angel Investing. My name is Gary Johnson III, founder and managing partner at Bison Venture Partners, and I have the distinct honor of providing this presentation to our BVP community. So today we've got a few different things to cover. First, actually going to jump in by building on the last lecture we had and actually discussing what are called Form Cs and testing the waters. So that's really important to know when we talk about understanding the rules and regulations, because not only are there rules and regulations for investors, but there are rules and regulations for businesses and startups that are seeking your investment. So it'll be really important to cover a few bases there. Each of those examples are going to actually be specific to crowdfunding campaigns. So in the last lecture, we talked about the difference between accredited investors and non-accredited investors, and that if you are a non-accredited investor, the only way to invest in startups at a broad scale is going to be by leveraging an investment crowdfunding platform. So Form Cs and the term testing the waters is going to be something that's very important to know. And even though pretty much all of the examples I'll be given today are focused on investment crowdfunding platforms, that does not mean that these deals are only for accredited investors. I've mentioned in the previous class that accredited investors actively do invest and can invest through crowdfunding platforms as well. So this is really just a great way to cover all bases by making sure that any deals we're talking about are accessible to accredited and non-accredited investors, so that everybody in our community is served. So I want to make sure we have enough time to get through everything. So I am going to go ahead and jump right into things. But hello to everyone, whether you are tuning in live or watching this recording. Thank you for tuning in. And let's get into today's lesson. So when we think about investing, again, specifically with crowdfunding, there's an important piece of paperwork you're going to need to keep in mind and make sure that you review. We won't talk about doing your own due diligence and analyzing deals today. That'll be in the subsequent classes. But today, I at least want to give you a high-level overview of what the Form C is, because it is a document that startups must file with the SEC, the Securities and Exchange Commission, to make their fundraising campaigns official. So if you are an investor in the stock market, you know that any of those companies that are listed there had to go through what was called an IPO, an initial public offering. When it comes to privately held businesses, which all of those companies were at one point, we're talking about angel investing. So we're investing in privately held businesses, not businesses that are listed on the stock market. But for these privately held businesses, these startups, to raise from the general public and include non-accredited investors, they have to go through their own version of an IPO. So that comes about by filing this Form C, because now this company intends on offering securities to the public, and securities meaning equity, some investment in the business. So the SEC exists again to protect investors, and this form is going to be the document that includes the specific deal terms that are offered to investors, and it allows for startups to be compliant with all SEC regulations. And that compliance provides for transparency and at the end of the day, hopefully protection of investors, because you will have all of the information needed to make an informed decision. So we talked about deal terms, and again, what they are specifically are legally binding agreements between a company, whether it's a small business, whether it's a technology startup, doesn't matter. It's an agreement between that business and its investors. Your deal terms are going to include a lot of different things that we are going to analyze when we get to our class on analyzing deals. But your deal terms are going to cover the valuation of the company. It's going to cover the interest rate if the company is raising a debt round. And also, I should note that the valuation is really only going to come if it's an equity deal. And even that can get a little bit tricky and have some nuance, because we'll talk about different types of equity deals, which include, on one end, what's called a SAFE agreement, which is a simple agreement for future equity. So in that example, we'll discuss what a valuation cap is, because the company raising on that SAFE may not have an actual valuation today. Or a company might be raising a priced round. And that priced round means that the company actually does have a valuation. Whether they describe it as their pre-money valuation or post-money valuation, we'll dive into those as well. But regardless, if it's an equity deal, the valuation and or valuation cap will be covered in the deal terms. Interest rate, again, specific for loans, whether that be just a standard interest rate percentage, or if it's a revenue share loan. A revenue share loan might be a combination of both an interest rate and an investment multiple. And then there may be some other terms outlined in that Form C as well. So as we'll discuss, businesses can get really creative with the terms that they offer their investors. And there are some that are pretty standard and across the board, such as the SAFE. That's very popular now. If a small business is generating revenue and has a solid business model, it may just raise money through debt, just a standard loan that everybody pretty much understands. But then sometimes a business may want to sweeten the pot, or they may want to just offer something that's a little bit more tailored to their specific type of business and the growth that they see and the trajectory that they're following. So some deals may have a combination of both debt and equity. There are deal terms where essentially it's debt in the short term that converts to equity in the long term. There's a combination of just straight up equity today and some form of a revenue share loan on top of that. So again, it depends on the type of business, but all of those things will be outlined as all of the deal terms that are packaged up and shared with you in the official Form C. So why this is important is because you, as the angel investor, have the power to evaluate those deal terms and decide for yourself whether you want to get in on this deal, support this startup, or pass on the investment. Whatever you decide, it is totally fine. It is your choice. That is the beauty of being an angel investor. It's your own money and it's your own portfolio. So as an angel, you just want to make sure that you are making a sound investment decision. And even if you are investing in a business just because you really want to support this founder, you at least want to make sure that the information is in front of you. Everything is transparent for you and for other investors, because at the end of the day, you at least want to know what exactly you are investing in, and the Form C will allow you to do that. So the Form C is going to include um, some other information that gets filed as well. So whichever investment platform you use, since they are regulated, the SEC is requiring that platform to capture all of these documents from the business that wants to raise capital from investors like you on its platform. So the materials that that business has to provide is going to include either their pitch deck, which is typically a 10 slide presentation deck outlining their whole business plan in sort of a um, almost a more graphic format. Um, but in some cases, platforms actually allow you to just sort of copy your text, all of the text that might go into a pitch deck, and upload that as their business plan, which you would just read through. So founders have the opportunity to get really creative, and this is where you get to see a lot of different slides that tell the story about the business, talking about their financials, talking about their team, showing great pictures and illustrations about their products. And that's where you get to see how good a business is at branding as well, because if their pitch deck looks really great, it's going to be more enticing for potential investors to get in and back that company. Other information that's going to need to be filed is going to include the business's GAAP financials. So GAAP just stands for Generally Accepted Accounting Principles. So that's the standard accounting principles that the SEC has adopted. So it may depend on the platform, but the business is going to need to show their financials. So you literally get to see how much revenue this business is generating, how much debt it's accumulated, what its burn rate is, how much cash it's spending on expenses each month. Some platforms even help you out and will give you some different ratios, like like the business's debt to income ratio, based on its GAAP financials. And then I think there's maybe one other piece that a platform like WeFunder might show, but we'll go to a few examples to actually see WeFunder.com, and you'll get to see what the deals actually look like. But when the business files their Form C, it's going to upload all of this information with that Form C. So you as the investor get to see all of this information. And this is actually, it's actually a pro for investors because we get to see everything, but it's a con for the business in their perspective, because the business maybe doesn't want to show its financials, especially if it's not performing very well right now, which startups typically don't. Typically, it takes a few years for a startup to really figure things out and start generating, significant revenue, one, and then profitability is a whole other challenge. So the reality is the SEC has now put this burden on businesses that says, okay, well, if you want to raise money from non-accredited investors, you have to show everyone on the internet everything about your business. So those financials are going to go back. I believe it's 2 years. If it's a new business, of course, you may not have 2 years worth of financials, but you're going to see the cash in the bank. That's what I was missing. You're going to see cash on hand as well. So even if the business has been performing well and maybe it generated $1 million in revenue last year, then you get to see, well, its cash on hand is $10,000 and its burn rate is $50,000, let's say, right? So you can see, okay, this business is burning money and it's running out of money, and it may be raising money because it can't survive without investor funds. So all of those things are going to lead to you being able to make an informed decision whether this is a sound investment or not. So this is one of the great parts about actually investing through investment crowdfunding platforms, because these companies are not supposed to lie to you. If they are lying to you, they are committing fraud. And just like we talked about the rules and potential fines and maybe jail time for investing if you're exceeding your limit or not accredited, the SEC similarly has fees, penalties, and things of that sort for businesses as well. So that's great for us. If we're talking about accredited investors, it's a different thing. So on the accredited investor side, you may only be seeing the business's pitch deck, and you maybe get to hear the founder pitch somewhere. But if you don't have a direct relationship with the founder and you're investing either through, say, a syndicate or like some sort of angel group, you may not actually get all of this information. So it, of course, has nuance there as well. It depends on if you are investing a significant amount of money, then you have more direct access to the founder. You can request this information. But sometimes if you're angel investing, and I think for a lot of angels, typically you do it by joining an angel group or maybe investing through a platform like AngelList. In those situations, you maybe only have the pitch deck. You maybe can email the founder and request a meeting, but a lot of times with angel groups and things like that, there's a quick turnaround to hear the founder's pitch, submit your commitment, letting the group know that you're interested in investing, and then actually wiring funds from your bank account to their bank account. So again, it depends on which sort of side of the accredited or non-accredited investor spectrum we're talking about. But from this perspective, thinking about investment crowdfunding platforms, these businesses are required to provide you with all of this information, so you're able to really see everything and make an informed decision. Can't stress that enough. So again, this is just full disclosure. Literally, there's not much that the founders can hide. Of course, here's what could happen. So there could be a significant difference in time from when a founder files their Form C to when they actually close their investment campaign. And we're going to get to examples in the next class again, but a lot can happen in that time. The founders don't have to update their Form C as they're operating. They only file the Form C one time per year if they're interested in crowdfunding. So when they file that Form C, they have 1 year from that time to raise the funds that they need, close their campaign successfully, and then put that money to work. They don't have to spend all the money, but they will at least have that money in the bank. So again, you have to think about, all right, well, if at the time market conditions were good, the founders started this campaign, they filed their Form C, I can see their financials. Maybe it takes this business several months to raise the money they need through this platform. You can imagine their financials are going to be very different. So you may actually jump into the comment section, as we'll discuss, ask some different clarifying questions, and go from there. So the question is, how often do companies on these platforms lie about their financials? So I've actually never heard of an instance where a company lied about their financials and the SEC took some action. I guess the nuance here is that the companies are not public, so they do have to go through strenuous reporting in just launching this campaign to raise money. But after that, the SEC asked for an annual check-in, but it's not like somebody's constantly looking at their books and then is going to go back and say, hey, well, you actually didn't have that much cash in the bank when you said that you did. Um, I'm going to do a search and see what I can find, but I've not heard of anything where a business was lying and then faced some sort of, repercussions. It's like there is a lot of trust from the investor side. I think that as when we get to doing your due diligence, you'll see that you can actually ask questions to the founders on their pages. And then I think you can get a better sense of, okay, do I trust this person? Do I believe they're, telling the truth about their business? And do I think their revenue projections make sense and all that kind of good stuff? But I've not seen blatant fraud. I've not heard of blatant fraud here. Of course, it can happen. I'm sure it has happened in some example, but I've not heard of any big story or anything like that. So, what's more likely to happen is that if the company lied about its financials, it just goes out of business. If it was just in a poor financial position and it lied just to make sure it could raise some money, and then it raised that money, and then startups fail anyway. But this business was being ran by people who were not being truthful. Then it's like, yeah, well, they went out of business, and that was that. So the repercussion is that unfortunately, investors lost their money. But it raises a good point, because maybe then there should be maybe some more reporting. I'm not sure what it would look like, but for the most part, I would say if the company has filed their paperwork, they're on the hook. They're absolutely on the hook, because they signed away. They signed off on all the risks, all the disclosures. They validated that, in fact, the statements I'm making about this business are true. So as angel investors, we get to take that into consideration and decide how we'd like to proceed. Another key term to be aware of when it comes to investment crowdfunding platforms is called testing the waters, or TTW for short. So with testing the waters, this just means that a startup can gauge interest before officially launching its investment crowdfunding campaign. And I think this is a really great opportunity for startups, because from the entrepreneur's perspective, it's a really daunting task to say, I'm going to launch a crowdfunding campaign and raise money from everyday people. Everybody in the world is going to be able to see my financials, and I'm going to have to work really hard to tell my story, talk about the business, provide a compelling pitch deck that outlines why, my vision as a founder is a good one, to validate that any traction to date proves that this could really be something, and that, all of your financial projections and all that kind of good stuff is realistic. So that's a daunting task. And on top of that, not only are you now raising money, which in the startup world, we always say, fundraising is a full-time job. So if you're a solo founder, or even just a startup founder with a small team, it's like now you have a significant amount of energy going into raising this money. And that energy is taken away from actually building the business, building and operating the business. So it's a lot. It's a lot to consider. And what's cool is that the SEC allowed for this new rule when it comes to investment crowdfunding. So I'm not sure what year it went into effect, but prior to this, you just had to make a decision. Do I want to raise money or do I not? If you do want to raise money, you have to file your Form C, and then you start posting all about it, putting it in your email newsletter, screaming from the rooftops that you're raising money. With testing the waters and this new rule, this allows for startups to take non-binding commitments from potential investors. So it's almost like launching a landing page for your new startup, if we think about it from an entrepreneur's perspective. Without building the whole product, you can put something out there to see if people are at least willing to leave their email address, right? So non-binding commitments is great because a startup can now go onto one of these platforms and they can say, okay, I'm not sure that I'm ready to really lean in and really focus on fundraising, but let me try something. And if I get some good feedback, then you know what, maybe I'll actually do it. So a startup can now create a draft version of an investment crowdfunding campaign, and they can share it with their community, and they have to let all of their community members know, hey, we're testing the waters to gauge interest from our community to see if you'd be interested in investing in our business. So imagine a local coffee shop who's very popular in the neighborhood, right? And everybody who comes in to buy coffee, they're all subscribed to the rewards program. They get emails about new products and flavors and discounts and all that kind of stuff. So the startup then emails their whole newsletter list, right? Now, these community members and customers can go to the investment crowdfunding platform and say, I'm interested in investing $100 in this business if it decides to officially launch this campaign. And that non-binding commitment is not an exchange of any money. It's just a placeholder. And it lets the founder of the business know, oh, wow, I sent this out to my community and the community is telling me that they're interested in investing $50,000 into my business. Like after the founder sent it out to the newsletter list, people started going to the page and started just making these non-binding commitments and saying, I'm in for 100, I'm in for 500, I'm in for 2,000, whatever it might be. So if that goes well, the startup is going to say, oh, you know what? I could actually do this. People are actually interested in investing in us. And not only are they interested, they're like really interested. They're bringing other people to come, or they're sharing this testing the waters campaign with their friends and in their networks. So you really get to get a sense of how people really feel about the business by testing the waters. So that's great. On the other end of that, the startup could launch a testing the waters campaign and get no traction or little traction. Maybe they get $1,000 in commitments. That's not significant. So the startup didn't lose anything by trying. And the good part also is that to test the waters, the startup did not have to file its Form C. So that's another huge positive. Because if the startup had to file its Form C, one, it takes time. Depending on the platform you use, it may cost money. And then also the startup may just be, it may not be in a good position right now, but it's ramping up, it's scaling, and it believes that, okay, if we file our Form C in 2 to 3 months, then we'll have a track record to show that, people should really take us seriously. So it just gives the startup a lot of flexibility and also an opportunity to adjust their campaign, which is really cool. So an example of that is maybe that coffee shop originally launched their campaign as a revenue share loan. So this coffee shop says, we want to raise $100,000 from our customers. And the way that we're going to structure that deal is that we're going to owe our customers, let's say 2x whatever they invest. So if they invest $100, we owe them $200 in return. And how we're going to make that return, how we're going to pay them back, is we're going to share our revenue with them. So maybe this business decides we're going to allocate 5% of our quarterly revenue to repaying this loan. So every quarter, however much revenue we made that quarter, 5% of it is going to go to our investors as a payment. And they're going to keep getting a payment every quarter until they receive 2x whatever they put in. So that's an example of a revenue share loan. Maybe that coffee company put that out there in their Testing the Waters campaign first, and they didn't get much interest. Maybe in the comments section, or maybe in their emails, they're hearing from customers, oh, this is great. I love the deal. I love the opportunity to invest in your business. I love your business so much, but I don't love the deal terms. Would you instead be interested in giving us equity in exchange for our investment? Then, since the business is just in testing the waters phase, it can switch from its revenue share loan to an equity round and say, okay, we're going to put a valuation on our company. And when someone invests today and we close our campaign, those investors, our customers, are going to own equity. They're going to have ownership in the business, not just a form of debt that gets paid back to them. So that's how flexible you can be. If a business wants to flip-flop throughout its Testing the Waters campaign, it can absolutely do that. It can just keep making as many adjustments as it wants. It can update its pitch deck. It can update its video. As we'll discuss, these businesses typically upload a video, some sort of like a highlight reel or interview with the founder, or the founder walking through their pitch deck. So all of this can be adjusted up until they file their Form C. Once they file their Form C, they cannot make these adjustments. The Form C is the final form of the deal terms, and whatever's on the investment campaign page is supposed to stay as it is. Now, there's going to come a time where if the startup was testing the waters and it wants to finalize this campaign, it wants to launch the campaign, I should say, it has to move from testing the waters to officially launching the campaign. So that comes with filing the Form C with the SEC. And what's interesting about that is that the business is going to file its Form C, and maybe there were investors very, very early on when the business started just testing the waters, and the deal terms were one thing, the campaign was one thing, and then over time things have updated, things have changed. But those investors who originally made their non-binding commitment, they didn't come back to the page every time there were updates made, right? And then there are new investors who come in at different times. So when the startup files the Form C, the investors are going to get a notice to come and finalize their investment. And in finalizing their investment, investors have to come, they have to review the updated terms and decide whether or not they want to proceed and fund their original non-binding commitment. So if they made a commitment early on and then the startup changed its terms, or maybe just things changed in the market, maybe Web3 or cryptocurrency was hot when the company first launched the campaign. Now crypto is like gone bust, right? Whatever's going on in the market. The investor may say, originally I was all in, now I'm not all in, and I want to cancel my commitment. totally fine. Or the investor can say, yes, I still want to be in. I like the deal terms, and I want to turn my non-binding commitment into a binding commitment and finalize my investment. So either way, if they made a non-binding commitment earlier on during testing the waters, they have to come back to the page and finalize their commitment to be included in the round. And if they don't, their commitment is going to be canceled. So the platforms actually do a good job of making sure that angel investors actually are updated over time. So again, it's just important to think about, because the founders of the business could be changing the deal terms over time and the market conditions change. So you want to make sure that you come back and you review the terms and all that kind of good stuff to make sure it's still a good investment opportunity for you. Also, just as an angel, this is your personal money. So maybe things were going great. You had some some extra savings or just extra cash in the bank, and you put maybe 500 into this deal, and now it's taken 2 to 3 months for the company to finalize its deal terms. And now you're like, well, I needed that money, so got to pay rent, got bills to pay, and don't have that money anymore, right? So those are things to think about as well. On the other end, maybe you're doing really great. Maybe you got a pay raise at your job. Maybe you won the lottery. I don't know. And you want to up your investment. You want to put more in. You can absolutely do that. So again, those are considerations you want to make before finalizing your investment. But again, as angel investors, you have the power to do that. Something else to think about is, and this may depend on the platform. WeFunder works in this way, but I'm not sure that Republic works in this way. When you make an initial commitment during testing the waters phase, you have a choice. You can either make your commitment just as yeah, I'm in for $1,000. You sort of put that into the little input bar, and you say invest, and then you've made your commitment, you've made your reservation. It's non-binding. They're going to call you back when the company files its Form C and all, and you'll be able to confirm. So you could do that, or you could allow the platform to hold your commitment in escrow. So the escrow account just means that they're going to set aside your funds, keep them safe in a bank. And you'll see on there that the banks are FDIC insured and all that kind of good stuff. But they're going to hold your investment in that bank account until it's time to confirm your investment. So I think that's a smart thing to do as an angel investor, because for me, I'm constantly putting my money to work. So if I have money in my account, it's going to come out of the account at some point for whatever reason, whether it's investments, whether it's for business, and I'm, purchasing equipment, whatever I got to do, hiring people, whatever. So if I'm interested in investing in this company on this campaign page, I most likely am going to transfer my funds into an escrow account that the platform manages, because I want that money allocated, right? I want it out there. I want in on this deal. And so long as things, stay the same, so long as I still want in, then I'm cool with the platform holding my cash and then coming back to me when it's time to confirm my investment. Again, this is a personal thing for me. This is how I think as an angel, but it just allows me to just not have that cash tempting me in my bank account. So it's totally up to you, but you have two choices. If you do decide to cancel your investment, whether it's during testing the waters phase or even after the company's filed its Form C, you have a certain amount of time before it finalizes its campaign to actually request your money back. And the platforms are really good about doing that. But again, for me, I have money moving in and out of accounts all day, every day. So if I want to make a commitment to something, it's better for me to put it in the escrow, because if I don't, I may not end up having the same amount of cash to be able to invest in this deal when it comes time to confirming it. So something to think about. But the finalization of the campaign happens when the startup closes its round. And that means that the startup has to successfully reach its minimum fundraising goal. So on a platform like WeFunder, typically the minimum amount they allow you to raise is $50,000. So any startup that wants to raise on their platform has to at least raise 50,000 to keep any of the money it's raised. But on top of that, the startup sets its own, target fundraising goal. Maybe they want to raise $1 million, or maybe they want to raise the maximum you're allowed to raise as a startup through investment crowdfunding, and that's $5 million currently. The minimum that they have to raise is at least 50,000, but they can raise up to 5 million. Another question is the $2,500 a year legal maximum accounted for when you transfer to escrow or when the final confirmation goes through? That is a great question. So how it's supposed to work is each individual platform is supposed to be tracking how much you've committed to deals. And if you have committed more than your max, so say there's one business in Testing the Waters and you say, I'm in for 2,500. And then there's another deal that's filed its Form C and they're closing tomorrow. This presents an interesting scenario. I'm not sure that the platform would allow you to invest, say, $1,000 into that deal that's closing tomorrow, but I would have to try it and find out. The good part is if the platform allows you to do it, it allows you to put that 1,000 in, then you're good. You're in on that deal that's about to close and you didn't miss out. The downside could be when you go to confirm your investment for the original campaign that was Testing the Waters. Maybe the platform then will say, hey, you've exceeded your limit by $1,000, or whatever it might be. And then they only allow you to put 1,500 in. That could happen. I'm just not sure. I'll be honest. The platforms are not perfect. They are not perfect at all. I actually know the founders of WeFunder, and I know some great people at Republic as well. And those platforms also are startups. So they've been around for maybe 5 or 6 years now, but even they're still like fleshing things out and building new features. And even though it's supposed to cap your investment, like it may not in every case. So sometimes there are bugs and things like that. And I mean, what I say is, hey, if they accepted your money, yeah, that's sort of their fault. But since a lot of this is like self-reporting and those things that we talked about, and it's like, okay, well, let me at least make sure that I can get in on the deals that I want to get in on. Because if you do get to a point where it's like, I really want to get on this deal, but I hit my limit, that sucks, because it's like, it was a really promising company. It was a company you really wanted to be a part of. So that's why it's important to just manage your own portfolio. And we'll talk about a tool. There's a really cool tool called King's Crowd that allows you to do that. So we'll talk about that in a future class as well. So yeah, I would always say, like, don't rely on the platform to manage these things for you. But if they allow you to put a little bit more into a deal, that's just what happens. And none of this, of course, is investment advice. It is just simply my perspective. And I have a significant amount of experience using these platforms. So I can tell you they are not perfect. All right. So next, you just have to remember that your investment is going to be deposited into the company's bank account. So the cash is going from your bank account to the investment platform's escrow account into the business's bank account. And with that happening, then the business has your money, and they have what's called a fiduciary duty to act in the best interest of you and the rest of their investors. And with that just comes an obligation to provide updates and be transparent about what's going on with the business. Because as angel investors, you want to make sure that the company's doing well, or if the company's not doing well, you may want to support in some way, right? You don't want to lose money as an angel. And if you're a value add angel who really wants to get involved and really open doors and help this company succeed, you just want to know what's going on so that you can step in and try to help out however you can. So there's actually a really cool investor update I got recently. I'll have to include that in next week's slides. But typically startups are going to provide either a quarterly update, or at a minimum, they should at least have an annual investor update. And that typically just comes in the form of an email. Sometimes founders will do a recorded video. But the ones that are the best, the ones that are my favorite, they're doing like webinars where it's like every quarter, every few months, they invite all of their angel investors onto like a big Zoom call, and the startup is going to walk through like the latest version of their deck. Whether they're fundraising or not, they're just going to walk through, here's what's going on, here's how we're doing, here's, here are good things that are happening, here are bad things that have happened, or here's a new product that we're launching, new feature, whatever it might be. And those things are really cool. So as I mentioned, Gumroad is a company that's in my portfolio, and that's an example that tends to do well with their investor updates. And it's a platform that just does well in general. It generates millions in revenue. They may have generated over 100 million in revenue, just money processed through their platform, not profit, but revenue. So still just a crazy number. And when I invested, it was a safe. So it was for future equity. It was not for equity immediately. And over time, the company's just been growing because I invested back in 2020, 2021. And the updates are never, hey, here's when you should expect to get paid back, or here's when our safe agreement is going to transfer into equity and you'll have shares in the business. But it's a lot of times it's been, hey, here's the new sort of like theme we're using for the Gumroad website. Here's a new feature we're launching for users of the platform to empower the creators that are our target customers. And those things are really cool. So usually it's a mix of like those things and then a little bit of, and in regards to fundraising, we're not going to raise around this year because we're performing fine and the team is still small, and we don't need the cash. And that's actually an example of a startup where I invested out of fear of missing out. I saw it on Twitter, and Twitter was just going crazy about the deal. And it was early. It was early in my journey. And I was like, man, this, like, everybody's saying like this is like a platform to to invest in. So, after doing my own diligence, looking at the numbers and all, I was like, this seems like a good company to me. Put a little bit of money into it, and then ended up sitting in on an investor call like months later. And I was like, man, I don't know if I really like the founder. Like, he was not given like vibes of, hey, I take your investment capital seriously, or I take running this business seriously. He was really like, it's kind of just me running this business, and yeah, we're generating, $100 million in revenue, and I'm fine with that. I'm not in any rush to grow it any faster. I'm not gonna seek any more investment capital right now, and blah blah blah. And it was just very nonchalant, and I was like, man, I'm an idiot. I invested in a terrible company, because what is this guy doing? He's not taking this seriously. But here we are now, 2023, and the company is paying me dividends, which is really like, it's actually rare in the startup space. So even I'm still like coming to terms with it, but you can't always, it's like you can't judge a book by its cover. Like, the company is performing great. Whether the founder is professional or not, the numbers speak for themselves. So say all that to say, if it's a type of company where the founder is transparent in those ways, I think that's a very good thing. But just know, like, you're taking a backseat. You can't jump through the screen and say, hey, I need you to get your act together and do XYZ in the company, because guess what? You are a minority shareholder in this business, and you have no say, you have no control. But something we'll discuss is, typically when the business raises an investment crowdfunding campaign, depending on the platform, they have to elect a lead investor who is going to represent like all of the crowd investors in that platform. They represent all the angels. And if the angels want to take up a vote and, say, take some action against the company, the lead investor has to initiate that. And then also, when the company goes to raise money again from a crowd of angels, I believe it's the lead investor who has to sign off on that as well. So that's like the little bit of control that's there. But as you'll see on platforms like Republic, I believe you can elect yourself as the lead investor. Like, the founder can elect themselves as the lead investor, which, like, okay, well, you have no control there. But on a platform like WeFunder, they do not allow anyone affiliated with the business to be the lead investor. So again, something to think about. But transparency, seeing updates, like, these are things you want to see with the company you're investing in. All right. So let me know if you have any questions about Form Cs and all of that good stuff as it relates to sort of just regulations and remaining compliant. From there, we will jump into setting measurable goals. And after that, just a brief overview of the different investment platforms. And I think that'll be a great primer for then reviewing different deals, going through a few different campaigns, and actually starting to talk together about what to look for, what you like, what you don't like, and what questions you might have. Because a lot of times you can find a deal, but not all the information is as easily available for you as you might think. So sometimes it just takes like talking through it together or even doing some other searches in other places